then we will take it from there.
Awesome.
Okay, ladies and gentlemen, welcome to the Superlative Podcast. I'm Edward Bushi, one guest. No edits, no post-production, just a sharp live conversation about what it really takes to reach high levels and what comes next. So let's get into it. Today's guest, Thijn van Helvoirt. I hope I'm pronouncing your
It was pretty good.
Oh, nice. Argues that Europe doesn't need to out-innovate anyone. That simply closing a 30% productivity gap could mint unicorns, and that the regulation everyone complains about is actually a moat. So before getting into that, Thijn, I want to say a really big thank you for joining us. Really excited to have you on the show. And before we start, could you give us 2 sentences about what No Such Ventures is and what you're building right now?
Yeah, sure. So No Such Ventures on paper is a VC like any other. We invest early stage startups, Series C, Series A. We do tickets. Well, we do tickets 500K upwards to 8 million per ticket. What we do radically different, or at least I hope we do different, is that we only invest with entrepreneurial capital. Meaning every LP that invests with us is an entrepreneur themselves. They're still building their businesses, or they have been doing that in the past, and now they want to help the next generation. We do that both on a deal-by-deal basis as well as via a fund. So we try to sort of combine the best of both worlds. But where we're radically different from an angel syndicate is that it's not that we're putting up deals for their approval to say, hey, I want to do this, or I don't want to do this one. But it's us, like a normal VC, deciding which deals we think are interesting, but we try to match them with the best entrepreneurial investors that are out there that will actually give them a leg up after the investment as well.
Nice. So let's put on the side for now. But I would like to get into your backstory here, because before you got into VC, right? It seemed that your background was almost adjacent to it. You're doing a lot of it started with legal work before that, and there was some stuff even before that. How did your journey get here? If you don't mind me asking.
No. It's an interesting question, and always when you're looking back at it, you can sort of perfectly explain how the whole journey made sense, right? But that's obviously easy to explain backwards looking. But no, so I have a very weird background. I started my career as an actor. I played in some movies that were broadcast in Dutch cinemas. Went to the Actors Academy of Maastricht. It's a city in the Netherlands that you probably never heard of, but within the Netherlands is sort of known for their good cuisine and good acting academy.
Oh yes, good cuisine.
It's all the way down to the south, so it's almost more like France or like Belgium. So they're a bit more known for their cuisine rather than
south of the Hague, for example.
It's way further south. So the Netherlands is it's sort of like an oval shape with sort of a little tail, and then at the bottom part of the tail, that's where Maastricht is.
Okay, gotcha.
So I did that. I moved into law. Indeed, a lot of people said that makes no sense. I always said, well, it's basically still acting, but now it's sort of your audience is just sort of the judges and the jury and the court. Although I was never a litigator, so that's where the story stops. Practiced law for a bit. I worked on the IPOs mainly, so the end stage of startup investing. Did big IPOs, Takeaway.com, Flow Traders, but you're one of 20 advisors on the deal, so I wanted to be a bit more commercially relevant. Worked in VC for a little bit, but I quickly discovered that I think that VCs, at least in Europe, are typically spreadsheet warriors. What I mean with that is it's not that it's not about Excel, but they're very good at Excel, but they've never set up businesses themselves. And I thought to myself, how can I sort of differentiate between what's really good and what appears to be good but will never get there? And sort of also, if I'm going to present myself to founders that needs to get investment from me and it's a competitive deal, what's my street cred towards the founders? Back then was a 27-year-old kid with sort of a good academic career, I guess, and a weird acting background, but sort of why ever take my money, right, over somebody else's? So I also thought, without that street cred, you're only going to get shitty deals, right? You're only able to invest in the deals that nobody else wants. So, and then also after investment, how can I actually help those companies? So with that in the back of my mind, I thought I actually also need to be an entrepreneur. So I set up my own business, micromobility, shared mobility, real quick. It's called Check. It's the line who just IPO'd, but then of the Netherlands. We started with moped sharing. Now we're also doing scooter, bike sharing, also car sharing. Company when we started was not doing the typical track of growing, and then we worry if we can ever get it profitable. We thought, let's get to profitability quickly and then scale from there. And then sort of 2021, when the capital market started to flow less and a lot of companies went bankrupt, and sort of the world woke up a little bit about micro and shared mobility, that, hey, wait a minute, these are actually not pure tech companies, right? They have a big tech component, but these also have just a physical operations. They have assets, they have vehicles, they just have people with blue collar that are working on it, right? So different economics. There we were the profitable company, so we could actually do a lot of good businesses and good deals there, and that helped the company. Stepped out of the business operationally almost 3 years ago, 2.5 years ago. Stayed strategically involved for a bit, and then we did an exit a little less than a year ago, and then since then I'm fully out. But in the last 2.5 years, I've been with No Such Ventures, and that's, I think, where we close the circle.
Yeah, totally, and excited to get it like into that. And I'm pretty taken by your story, right? So you work with VCs in startups as a legal
Professional, yes.
Professional, yes, sorry. And then you decided that you wanted to get into startups and become an entrepreneur as well.
Yeah.
And then your first startup like really wanted to start instead of scaling profitability, and then what is crazy about this, your first shot did really well.
Yeah.
So like I'm wondering like what is it about profitability and versus going after scale in terms of a mindset that made you guys like successful?
Yeah, so I think there are a couple of things to that.
Yeah.
First of all, and it's very easy now to say this is why I was successful, right? I also just got a shit ton of luck. So full stop.
Of course.
I've put a field there. I've made many decisions that turned out to be the right ones, could have been the wrong ones. And there were some very wrong decisions that I made that my co-founders corrected. That and otherwise we also wouldn't have been here, right? And that includes small fuck ups like wiring $500,000 to the wrong bank account. Happens. Or I don't know. There have been many things. So I also am very flawed, and I also made a lot of mistakes. But I think what we try to do differently is we made every decision based on data, and I really mean every decision. So gut feel out of the window. It's look at the data, and we try to solve everything with tech. So like a tech company, we try to say, okay, instead of, I don't know, we have a moped that's sitting idle for a while, so maybe nobody's renting it, so it's not making a lot of money. We can do a pickup and relocate it into sort of a more popular area. That's what everybody did back then, right? And then cost you about €8 for a pickup because you need to have a van, you need to pay somebody to go there, and there's a lot of dependency because you have people, so people can decide to not show up, can decide to get high, like stuff can happen. The van can get a flat tire. You can also think, well, we can create an algorithm that sort of makes vehicles gradually cheaper if they're standing idle for a longer time. So sort of in that way, you're making it way cheaper. And then at some stage, we also thought, okay, we can also, instead of sort of trying to relocate organically, we can force it by saying, well, you have some people in every society, in every group. I actually got the idea. I was standing on a festival, and it was a techno festival, and we paid, I think, €90 or something to get in there. And I saw two guys, and they were collecting glasses, just going around ground collecting glasses. And I thought, you paid $90 for this ticket, and now you're spending your time here collecting glasses for the 50 cents of sort of how do you say, deposit you get on those glasses. It's like, so there are just people like that in the world. So we thought from that idea, they're everywhere. So we decided, let's do sort of an app that's forever in beta, where we just have a selected group of people that want that whenever they're within 500 meters of a moped that we think needs to be moved, we just give them 3 trips for free. The first one to move the moped, and then sort of the second 2 they just get for free. Why? Well, because as I said, like a van cost me €8, but a trip, cost price of a trip is about 28 cents. So 3 trips less than €1. So it's like 10 times cheaper for me to give 3 trips for free. And it's great marketing because they will tell all their friends, oh my God, I'm so smart. I'm in this special beta app.
I'll just put the mopeds back in where they need to be.
These guys are mostly students, so they have free public transport in the Netherlands, so they will take a bus even to pick something up. So we started with 500 meters, we expanded that scale, and sort of if you radically think like that, So for
Yeah.
instance, some of our competitors thought, okay, you just always need to take a Lime. If you compare to Lime, right? You
Yeah.
just
Yeah.
think about the user journey, which is a very sort of popular way of sort of how startups think about sort of how I'm selling my product to the users, right? Okay, what's the, sort of the customer journey or the user journey, and what are the use cases they're using it for? You think, okay, you need to use your Lime, you need to go to your grandma, you need to go to shopping, whatever. So they do
Yeah.
all these
School.
marketing campaigns, take your Lime to your grandma. And we always thought, okay, well, have a look at the data, right? If I just look sort of where within my service area, because we just have an area within the city that we serve, right?
Yeah.
Where do I see actually the most trips are being taken? Well, 95% of the trips are being taken in a very small part of that service area. Then we are mandated by the municipality, we just have a license to operate an X amount of vehicles. And then we were looking,
Oh, okay.
so that's just a limitation, right? You can only have
Okay.
1,000 vehicles, 2,000 vehicles in the city. So
That's the
then
box
we
you're
were
working in.
yeah, so that's the limitation you have. Then we were looking at, okay, people are opening their app. You call it an eyeball, right? When people are opening the app, and then we calculate the distance to the nearest vehicle, and we saw if people had a vehicle within 200 meters, conversion was more than 50%. If it was further than 200 meters, conversion was lower than 50%. And then
200 meters, the magic
200 meters.
number.
So that means
Okay.
the big thing you need to optimize for is density, right? Because if it's close by, otherwise I think why bother? Because what's their alternative? Well, that's the last piece of the puzzle. Everybody's multi-homing, meaning if you have 3 different operators in a city, they all have check, Lime, Voy installed, right? They all have Bird, Lime. Like it's just so they're not that like you can always say, well, you need to make them brand ambassador, blah blah blah. In all honesty, a big part of it is commodity for the
Yeah.
user. So
Yeah.
you
Yeah.
just need to be the nearest vehicle. So with all these things in mind, we thought the only logical thing to do here is make our service area 30% of that of our competitors. So our density is always the best. Our users will go to work and to school Monday, Tuesday, Wednesday, Friday, and then when they're going to visit their auntie in Amsterdam North, they'll take the competitor. But I get 80% of the trips in my app, and I don't even
Oh.
need to operate in these edges of the city, right? So that's just a
Yeah.
different way of thinking about it. If you just your gut feel will say no, it makes sense to say we need to cater to every journey they want to take because they need to grow fond of your brand and they will pick you over.
But let the blitzscaling companies deal with that problem, right?
100%. Yes.
They want to spend a lot of money doing it, so let
Yeah.
them like play
And that
that game.
and that's also we found out supply drives demand in our business. So that
Oh yeah.
also means so the more supply there is, the more demand you create. Also meaning we want cities where there is competition, meaning you don't want to be the first mover. Um, because everybody that has Lime installed, and then there's a new entry into town. Check just arrived. Everybody wants to try it out. So what we did just 3 Fridays in a row, all trips for free. First
Woo.
Friday, a couple of people drive, no big deal, right? But then people
Yeah.
start talking. Check is doing 3 Fridays. Next Friday is the next Friday. Next Friday,
it's,
mayhem.
li-
Friday
it's
afterwards,
like
more
a
mayhem.
happy hour.
Yes, and then the whole day, right? People got crazy, but it was so sticky because everybody had their app installed. They have used it
Mm,
multiple times because
yeah.
they have multiple Fridays to use it, so they had it in their behavior. That's one of the apps they want to open. Then the game is
Yeah.
just become the first to open app. In most cities, we were not the first entrant. We were not the first mover. We became dominant in the market, more than 50% market share within 6 weeks in most cities.
So there's something to be learned there, right? Like you don't need to be the biggest player, right? You just
No.
need to be smart about like how you use or right, smart
Yeah,
about like your location and smart about how you operate.
yeah,
Yeah, and by the way, for the folks just watching this right now, we're talking about Czech, and we're talking. It's basically you say mobility, but it's basically mopeds that electric mopeds that people can use to travel around, like
yeah.
let's say Amsterdam or other
It,
European
it
cities.
yeah, it's called shared micromobility. So what you
Mm.
do is you have just a city. There are 1,000, 2,000, 5,000 mopeds in there, or
Yeah.
e-bikes or scooters. Right?
Mm.
We do it all. We also have car sharing now.
Yeah. Yeah.
Sorry for a different time because otherwise it becomes too lengthy, I think. But sort
Yeah.
of
Yeah. Yeah.
you open your app, you can take one, dump it wherever you want within the service area, and go about your day.
Gotcha, gotcha. So, I want to because that's a great theme, right? Like you don't need to be the biggest player; just be smart about how you use data and your area, right? So, what before we like expand on that more, right? Like, you talked about another dilemma or issue that's happening in European VC. You're saying that they're spreadsheet warriors. What does that mean? Like, are they just like divorced from the whole operations process? They're not, they don't know where actual innovation is coming from? Like, what does it mean that you're a spreadsheet warrior?
Yeah, that's a good question. Because the literal sense, of course, means they only look at Excel and nothing else. What I mean with that is a bit broader. So what you
Mm,
just see happening a lot is that VCs in Europe versus VCs in America, in the US, and I'm generalizing a little bit, right?
okay.
There are European VCs that are doing a great game, that I think they are doing really well, but generalizing a little bit, they tend to be less entrepreneurial background, and more just consultancy background, investment banking background, because that's perceived as quality in the Netherlands. They can create very good spreadsheets and spreadsheet warriors, right? And they think that every business, and in PE, you can sort of do that, right? In private equity, it's a bit more mature. You can just think, okay, what are the cash flows coming out? How can I value this business? The fallacy there is plural,
Okay.
because at first, when you invest very early, if you're just going to model out what they're going to do, the sort of the best success case you got to model is their success with the current product they're selling into the current ICP, which is just 9 out of 10 times not true, right? They will pivot left and right. They will find, so that's actually not a good criteria to look at all. So you will always
Mm,
underestimate that. Second, that's a bit my pitch sort of for myself moving into VC, but first being an entrepreneur, right? How can
yeah.
you actually select Uber from the almost Uber if you've never done it? And how can you
Mm,
also help your startups a little bit better, because that's what you need to do as a VC. You have two things, right? You shouldn't be too arrogant that you think I'm smarter than the founders I'm investing in. You're not, right? They're always smarter. They know their product better. You should also stay your hands off the wheel. But what you do have is you have one, a helicopter view, so you can just see we have 20 companies in our portfolio companies. They all think their problems are unique. 70% of the problems are not that unique, right? So we
mm,
can just say, well, this is how company this dealt with it. But what we also can have, and that's where your entrepreneurial background, but also that of your LP should come in. Well, you can also say, well, these are 5 guys that tackled that same problem in this way. Have a chat with them, and it makes you also more emphatic to actually help them work through their problems.
mm.
So if you think about how can you be a good venture capital investor, well, you need to be contrarian, but you need to be right.
Okay. Yeah.
Yeah,
Gotcha.
because that's very tricky. Because if you're just a spreadsheet warrior, or sometimes you can call it sort of a checklist investor, right? Sort of an investor who says, okay, 100% year-over-year growth, sort of good margins, it's the best team ever, tick, 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 everything ticks, super nice, but then also valuation is going to be here,
Yeah.
right? So you need to sort of see something in a company that others are missing, or you need to be able to sort of find the diamond in the mud that you can polish and you can help them, and only then you can get real venture returns. And I think that the issue with treating venture, and that's what they do in Europe, a bit more like private equity, you will always miss that. So you will do some good investments. You will do investments in sort of the obvious success stories,
Yeah.
but less money to be made there.
Yeah.
If you're like if like you have so many companies that did very good investments. Lovable is of course one of the European darlings that everybody knows, right? There are some investors that invest in Lovable early enough to make good returns. There are also some investors, looks nice in your pitch deck, right, to sort of your LPs, but they won't make a lot of money on it. Why? They paid way too much when they invested.
Hmm. So you paint a picture where like a lot of VCs are see the lens, sorry, see their startups through the lens of a spreadsheet, which means
Yes.
that you can't see that's what's outside of the
No.
scope of what of that tool. So okay, that's interesting. And another thing just to set the ground up, right? You were talking about um, a lot of people are critiquing the European landscape, right? As being heavily regulated. Not a lot of startups can operate there. That's why we get these kinds of VCs, right? Who are spreadsheet warriors.
Yeah.
I'm putting things out there. I
Mhm.
wonder if you can take that and say like, no, there's you're seeing this part wrong. But I also mentioned, sorry, I also heard you mention in the last onboarding call that it's a moat. Do you want to explain that a little bit more?
Yeah, sure. First off, of course there are issues in Europe, right? I'm
Mm,
not denying that. I'm also not denying that we have a lot of regulation. That's also
mm,
a hindrance to startups. I'm not denying that it would be very great if we had one unified market, and we're very far away from that. So we're missing a lot of opportunity there. I'm also not denying that it's in the European culture a bit frowned upon to sort of show yourself, right? So
oh, okay, yeah.
it's
Toot
very
your horn, so to speak.
it's very Calvinistic. Yeah, don't toot your own horn. Like act normal, then you're acting weird enough. It's literally a Dutch saying. It's like so that also doesn't see entrepreneurs as heroes, which I think we should do more, right? And but we're very afraid of that. We're very afraid to glorify people, to so put people on a pedestal. So hence that's all hindrances. That's all true. But it's very short-sighted in a way as well. Why? Well, you see a couple of things geopolitically just happening. We don't have to have a whole geopolitical discussion, but I think it's safe to assume that everybody watches the news. It's a different world we're living in today than they lived in 10 years. There's a
Mm,
different relationship that the US has with most, right or wrong, but with most countries in the world than they had 10 years ago.
yeah.
Meaning, you also see that in the capital markets, more capital is being moving into sort of less turbulent, again, not saying good or bad, but just less turbulent, I think is a fair sort of neutral assumption. Less turbulent water. So you see, for
Mm,
instance, public markets in Europe, a lot of capital is flowing in, but you also see that happening into the private markets. And just
mm,
they don't like if you just talk about public markets, right? It's totally not my expertise, but if you just see sort of supply and demand, more people want to deposit capital in Europe. It's not that there magically is going to be more stocks to invest in, hence prices go up, right? It's just supply and demand. So that's
yeah.
already something you see happening. Well, on top of that, you just see a lot of regulatory tailwind, a lot of support within Europe, at least, to sort of allocate more capital to venture, to boost innovation a bit more strongly. For instance, there was, I think, 2 weeks ago, a European parliamentarian who said every European pension fund should invest 2% into venture capital in Europe. Like, we're very far away from actually doing that, but European pension funds are huge, right? The Dutch pension funds are one of the largest in the world.
Yeah.
It's like literally, even though we're such a small country, so there's so much capital that can flow in there. So that just means that a lot of constraints that we used to have are slowly being solved.
Mm,
Then so I'm pretty bullish on the chances Europe also, because just catching up. So this is the point about labor productivity, right? Europe is roughly 25-30% less labor productive than the US is, just meaning we're just less efficient with what we're doing. That means we don't need radically new invention to create unicorns. The only thing, even just
okay.
catching up, just, and that really relates to how we did it at Czech, right? Just
Mm,
operationally efficient, just do it better, then you can already build great companies. I think that's true everywhere. Also, almost the blessing of being a bit behind, have a lot of old industry that hasn't seen a lot of innovation, innovating that and bringing that up to modern standards without trying to sprint ahead will create already quite some unicorns. And from a VC perspective, investing sort of with a relatively small fund, that's literally what we're trying to do, right? But then to your second point, indeed, everybody always says, "Oh, regulation in Europe, it's stifling, it's hindering innovation." That's true to a degree. But what's
okay.
also true is it's one of the biggest reasons why a lot of big US tech companies are not being that successful in the Netherlands, are not being successful in France, are not being that successful in the UK, not being successful in Germany, is because it's very hard to understand Europe and to play Europe as a single market. And they're just European companies that are better at that game because they understand dealing with regulation from their own country. So
Yeah.
maybe in their member state, regulation is radically different than another, but they at least know what regulation is and how to deal with that. So you can, in that sense, also see it as a moat. If you can play the regulatory game,
Mm,
you can actually just have less competition from sort of the big US tech giants and still do really well. And
you know,
I'm just pretty bullish on those companies.
yeah, yeah. You remind me of we're talking about fragmenting markets. You remind me of Canada, where I live in, right? We
Yeah,
can't even easily do trade between different provinces without having taxes between our provinces.
yeah, yeah. That's also
So
crazy, right?
yeah, so it forces a situation where we're only dealing with U.S. customers, and it's easier to sell to U.S. customers. It's just a
Yeah.
weird. dynamic. So I like the picture you're painting there, right? Like European companies that are operating there are to a degree the ones that survive
Yes.
that wall, that filter, right? And American companies haven't even gone through that filter yet. So that's really really interesting.
No, and the US market is huge, so it's easy.
Mm,
So why go to Europe, which is sort of in their perception, maybe I don't know, a maximum you can add is sort of 60-70%, right? So
mm,
if you manage to conquer Europe without any sort of regulatory hurdles, so
mm.
you can also think, well, I can make billions in the US. Why even bother? So it's sort of like but the opposite is also true, right? A lot of
Okay.
Europeans paint a too rosy picture, I think, of selling into the US. We have a few of our portfolio companies that sell into the US. We have two portfolio companies that get the majority of the revenue in the US. They all think, look at how successful I am in the US, like so. But then scaling it deeper into the US, you're going state by state. You're going, and then you also find out there are actually quite some hurdles between the states and the US as well. You also find out competition is killing. So yes, it's pretty easy to get you always find some customers. There are so many customers, right? But it
Yeah,
doesn't
yeah.
mean you will kill it. And the moment you're a bit more sizable, then you actually run into the competitors. Then you sort
Mm,
of reaching out of your niche. It's also much harder to do well. So I think
mm.
also from a European perspective, maybe also from a Canadian perspective, hard for me to judge. We also always think the grass is so much greener at the other side of the Atlantic.
Yeah, yeah. There's always trade-offs, like depending
Yes.
on the market. You just need to be, I guess,
and
honest
and
about
and
them.
then you get back to the cultural point. In Europe we're a bit more modest, where we don't toot our own horn, as you said. So we will not sort of, in the US it's different way. So in the US they will not call the bullshit, right? They will just say, yes, you're right, we're the best, and there are no regulatory hurdles here at all. Nobody will tell sort of the sober reality. Well, actually we also still have some hurdles, because they don't want to talk about it. And in Europe we're a bit
Mm,
more modest to say, yes, these are. You even hear me say on this podcast, right? I'm trying to be
yeah.
so. I also feel when I'm doing these speeches, I want to sort of be a bit positive and optimistic, but I also sort of my European culture screams to me, yeah, but you also need to be refined. You also need to tell them, yes, it's true. There are
Yeah.
regulatory, which is true.
Yeah, yeah. Well, look, this is a podcast that we chat with entrepreneurs and VCs, right? So this is kind of the space where we want to talk about like successes, and because it's there where we learn things, right? So I'm really really appreciative that we're getting to this insight that not a lot of folks here in North America like appreciate very or can see very easily, right?
Yeah.
So I want to get to another point that you talked about. You mentioned to do really successful, you don't need to be the Uber, right? You just need to like have very good operational efficiency and know your market. You set a metric that stuck with me. You pointed to labor productivity just being 30% lower in Europe, and if you can
Yeah.
solve that, that's where a company can do really well. I
Yeah.
mean, what does that what does that productivity gap mean? Like to me, it sounds like a line on a spreadsheet, but what does it mean?
Yeah, it looks like a line on a spreadsheet, but it's actually a combination of how businesses are doing or are operating their businesses across Europe. So, for
Okay.
instance, looking at sort of the manufacturing space in Europe, it's again very fragmented. You have a lot of SME manufacturing. It's just like there's just a lot of that. So the game to solve is in Europe is actually sort of not okay. The easy game would be okay, just need scale, right? Economies of scale. If you're bigger, you're more efficient, yada yada yada. Yes, but like the way to bridge the gap is actually how can I, with tech, with tools, help these SME manufacturers to be more efficient. So the last
Small
investments we
medium SME.
SME,
Oh,
small medium
okay.
enterprise.
So yeah. Okay. Gotcha.
Sorry.
Yeah.
SME, small medium enterprises, companies that are doing whatever 50 million in revenue, right, a year,
Yeah.
like
Yeah.
relatively can be even way smaller, right? Can be companies doing 5 million revenue. The point being, sort of in Europe, you have take Italy, take Germany, big industrial bases, right? But a lot of small manufacturers. Take the Netherlands. Everybody knows ASML, right? ASML.
Yeah.
But sort of the supply chain of ASML is also 1,500 companies around the city where ASML is located that are all sort of servicing into ASML. So
Mm.
if you can find ways how these relatively smaller companies can operate at a high operational efficiency, your market is huge. You don't need radical reinvention because there's such a big market for that, and that's just catching up. because the invention has been done. And I think if you look at Europe as a continent, that's also a bit of a fallacy in that sense, because Europe, yes, it's a continent, but big regional differences, right?
Yeah.
But if you look at Europe as a continent, we've been very good at invention, but very bad at commercialization. So the thing we just need to do is commercialize those innovations, that inventions, a bit better to actually help the broad majority of our industry and of our companies that are just that sort of 30% behind in their operational productivity, which is just easily to measure in labor productivity per GDP, right? So that's just why it's just an easy number to grasp. You can do great, and yeah, that's a bit sort of one of my bull cases, at least for Europe. You'll see big regulatory tailwinds, a lot of capital flowing in, and the only thing we need to do is make sure that we deploy invention that's already there, just scale it, commercialize it, and deploy it across all these SMEs in Europe.
Okay, so you're painting a picture where like these small and medium enterprises seem to just be, you're saying the money's there, the market's there. It's just that these operators are not. I'm going to make it very crude, right? They're not sending enough quotes as much. They're not closing their leads as much. It sounds like that. Or it's operations. Sorry, you're saying, right?
It's almost more physical than that. This is also true, but it's also more just literally in physical space. If you look at a manufacturing plant in Italy, the conveyor belts are 20 years old, right? There are still a lot of pen and paper. It's not. Everybody knows that you can sort of digitize that and that you will be more operationally efficient. But it's very hard because all these companies have been so decentralized. There's not a big management that's saying you need to do that. They feel that sort of all these suites that are catering to manufacturing plants that have big scale. Why? Because that's sort of where they were selling into in the US, because there everything is at the bigger scale. So sort of there is just not a real big solution out there for them, but the market, although spread out, is huge. And I think with the onset of AI, and that's also what you now see happening across the globe, right? But it just becomes cheaper to make specialized solutions, and that's actually a game changer for sort of the whole European industry, because what we need is specialized solutions at scale.
Gotcha. Yeah. So like for example, like agents do certain workflows, or even robots do certain like workflows inside a business, for example.
Yes. And also because sort of made in Europe, right, is becoming way more popular. You see sort of lots of procurement with a mandatory requirement. You need to buy a European, or at least needs to be 60% produced in Europe. Of course, the start of production is all in China and a part in the US, right? But at least the assembly then needs to be in Europe or something. So there's just a big push that there will be a market for European solutions for a long time, even at a premium. So just cater to that.
Yeah. So from your perspective, like it seems like the kinds of companies that you're. And by the way, I think maybe this is like a good point to get into, like with or the new direction, like go into what you guys are doing at No Such Ventures, right? Like it seems then the companies that are gonna really do well are people who can close that productivity gap. So it could be like AI provisioning, but it could also be like machinery as well. So are you like a tech and a hardware kind of like you see that back it? But you want to talk about it?
Yeah, that's a good question. So we are software. We always say we're software first investors. But for instance, hardware enabled software. I don't know, you have a little sensor that you put into machinery. We looked into a company that created a little sensor that on the vibrations of the machinery of a manufacturing plant could charge itself. So suddenly, like one of the issues why there's not just sensors in sort of everywhere is because it's just very hard to, you either need to connect it to the main electricity grid of the machinery, which just requires massive rerouting, or you just need to buy all new machinery. But as I said, most manufacturing plants have invested millions and millions, and the stuff's just there. So what you
Yeah.
can do is put a sensor on top of it. So they had little, so they use the vibrations of the machinery to generate the electricity for the sensor. So you don't need to drive it.
Oh.
Super smart, like small. So it's a small
No
hardware.
batteries, no cables.
No, so super smart, right? So it's a hardware invention,
Yeah.
but it's not that sort of their whole business is hardware. The business is, of course, okay, now we can have 10,000 sensors in this machine. So what are we going to do with the data? So their whole business is sort of the interpretation of the data. How can we deploy agents to say, okay, this machine is overheating, blah blah blah. So they're making money on the software, but it's hardware enabled. Like I like those type of companies very much. But also, in all honesty, I think all sort of SaaS investors, at least, that sort of 10 years ago, it was SaaS, right? They're all scratching their heads a little bit. Sort of the typical economics around just pure software are just changing, and that's partly due to AI, but it's also partly due to AI, which is disrupting software, but also AI is also disrupting hardware, right? So hardware becomes cheaper, more easily. You can test everything digitally, for instance, right? Like back in the day,
Interesting.
everything from protein folding until literally sort of wind tunnel testing. You do that digitally with a digital twin these days. Like it's not actually
Mm.
a physical wind tunnel you need anymore. So it's not only that AI is sort of disrupting these SaaS modes that you used to have, which makes software less attractive. It's also that because of this AI, this rise of AI, just hardware becomes cheaper and more scalable. So the capital efficiency goes up, meaning it's let me rephrase. Right now, I'm
Mm.
saying we're, or maybe gamble a little bit towards the future, but now I'm saying we're sort of software first, and this hardware-enabled software we can invest in.
Mm.
I'm fairly certain that if you ask me again in 10 years, we will do way more hardware.
Oh, okay. Well,
But
yeah,
don't tell a
like
lot of partners of No Such Ventures that, because I'm not sure they're on board.
yeah. Well, that's something to like develop as a thesis for the
Yeah,
future,
and
or
and
your
you should.
next fund. You know.
Yes, and you should also think, where's your value add, right? Our whole value add is we have the best entrepreneurs of Europe investing in the next generation of best entrepreneurs. So our
Mm.
value add is very much in commercially scaling across Europe. Exactly,
Mm.
sort of the issues that people have, the perceived issues of Europe. That's what we can sort of cater to, because we have people that dealt with that, and but by default almost a lot of that is in software.
Mm.
So our value add for software companies right now is just the biggest. Just commercial scaling is a different skill than, I don't know, hardware development, right? I'm very little of help. I don't have a PhD in physics. Like I cannot help there, and most of my LPs also don't have that.
Mm. So,
um,
yeah. So I get the. It's interesting that you point out that AI is really like getting or putting the question of SaaS in question. It's I love the other angle that it's also disrupting how hardware is being utilized, right?
yes,
And it reminds me of a conversation I had with another VC where SaaS companies are in trouble because eventually a company that needs services could figure out how to internally build their own
yes,
tooling to, like, I don't know, do invoices or do purchasing of their materials, for example.
yeah,
But like I my take on that is it's very hard to even for a company to like set those things up. It's very hard to like think agentically, set up the agents, train your agents, and build it out. But like, what's your take in companies trying to like make specialized solutions? Because
yeah. I think you're leading with the right word, specialized solutions, right?
mm,
Because if it's very specialized, for instance, also I still believe sort of very regulated spaces that has more defensibility in it. So sort
mm,
of. But what type of moat are you building? Like a lot of moats are eroding, so you need at least have a data moat. If you're not sort of, because that's what those agents don't have, right? You can't sort of build up your, so then at least you need to say, well, we've been sort of building up this database for the last 5 years. We have so much insights there that's the mode we can sort of use, that we always have a better product that what you can build yourself. For some
um,
for some tasks though, I think it's just true. Like I look at our own setup. We sort of are automating a lot of stuff. That's even a year before we were doing manually, or we used the tool for. And it's small things like sort of a meeting booking tool. You don't really need a meeting booking tool these days anymore, right? It's sort of although a lot of these tools are already for free, right? Google gives it for free, and
Calendly,
a lot of,
cal.com. Yeah.
so there's already lots of free stuff out there, but there are many solutions these days with Claude connected to N8N or something, which is how we're building at the moment. But we'll just give you a lot of solutions and think about investor platforms and stuff, right? It's not that complicated, and there's not a lot of as in technically, it's just access of data that should be available to different investors, and some calculations on sort of, hey, I invest in this company, these are my returns, and you need to do capital calls, but it's some complicated formulas and access to data, and that's it. So there's very little data moat that you can build up. Sure, you're servicing 50 VCs or 50 PEs, but there are just some of those industries where I think, oof, it's tough if you're building in that space.
Yeah.
Because these companies are thinking about what can we do ourselves. But then also the stark reality. I don't know if you've ever worked in enterprise. I haven't, but I have some friends that work in big enterprises. They move very slowly. So I also think the next 10 years, at least in Europe, and that's again maybe the sort of the labor productivity gap again. But I think what I hear, and I have no reference point, right? Because I don't speak a lot with sort of CEOs of big enterprises in the US. But what I hear is that in the US enterprise boardrooms, AI adoption is being taken very seriously, and that's just different in Europe. So my perception of sort of all these enterprises, the bigger companies moving a bit more slowly, also gives these SaaS companies a few more years to sort of survive, do okay-ish, maybe show pretty decent growth, which will also fool or not fool, but will keep some investors at least hooked to a form of SaaS for a few more years.
Yeah, one thing I learned like recently while helping some clients of mine is that when you're setting up agents, right? One thing we're no longer in a world where we're thinking about prompt engineering anymore. We don't need to say think like a VC or think like this kind of operator. It's all about managing the context around it. And then now there's a new term called context engineering. I've just like recently just got into it, and you're making me think now because you're dovetailing the concept of data moats, right? So you're making me think: is there something I had with context moats as well? So I'd love. I'm not necessarily prepared for that discussion because I still need to know the concept a little bit more. But would love to have you maybe in a future podcast and discuss even that topic because
sounds fun.
Yeah, because it could talk about where software companies or agent builder companies could really stand out. I'd love to discuss that. But Thijn, just to get a better sense of no such venture, do you want to talk about some of the companies that you guys are backing? Because you were talking about closing the productivity gap, killing it in Europe.
Sure. So the most recent investment we've done, but it's not public yet, so I can't say too much about it. But that's literally catering to this problem. So they are. So I'm not gonna mention the name, but they are literally building software to make manufacturing in Europe better, more efficient. It's a great company where sort of and that's what I said earlier, right? Like I think 60% of our investments are contrarian in the sense that we think we see something that others are not seeing. So sometimes we call it a little blemish that we see on things that we think is actually not a blemish. So some companies, I know this company, for instance, they've been very successful. They have previous businesses, great founders, but they can also self-fund if they want because they've been very successful. So why raise ventures? So a lot of VCs are already thinking, okay, what's going on? What am I missing, right? And we had some honest conversation with them about it. But we think we understand, and I don't want to spill secrets or whatever, but we think we understand why this is actually a venture case, very much a venture case. And then that's, I think, a big part of our model as well. We got a sort of a proprietary access to this deal because of our network. Because if you want to do great in VC, you sort of need to have access, right? You need to see the deals that you see. You need to then select the right deals. Need to pick the winners from the losers. Then once you selected them, you also need to give them an unfair advantage. You need to win them. Sorry, so if there are 5 term sheets on the table, they need to pick you. And then last step, Now you've invested. Now you need to give them a leg up. But the first part is always underestimated. So if you don't have proprietary deal flow, if you're only seeing deals that everybody else is seeing, you're always paying a premium. Your returns will always be sort of mediocre at best. So I think almost all our companies either were proprietary via proprietary access of our network, or there's something that others don't like that we think that's very investable. We've invested in a founder couple, for instance, sold that company to a UK firm. Company's doing great. Was good exit. We've invested in sole founders. We've invested in a company that it's a German company. When we invested, they were growing 5% year over year. So everybody thinks 5%. Okay, all VCs are out, right? But what we saw was, years before they did great. So what happened? Well, we saw that some of their major clients went bankrupt. So we thought, what if we try to normalize for that? One layer deeper, try to look, we actually saw that lots of new customers were signing on. Then what's the reason why these companies actually went bankrupt, right? Is there a heightened risk of bankruptcy in their ICP?
What was it because of the startup?
Well, we tried to find out, right? This was a family business of 160-year-olds. This was a big insurance company. This was a black swan event. It was also not related to each other. These guys just had dumb luck, shittiest year ever, but the underlying fundamentals looked great. To sort of help this company survive, their current investors put up, but that's very European spreadsheet warrior likey. They thought, how can I protect my investment? Well, I do that by giving them an investment with a very high liquidation preference. I won't get into too much technical details, but that just means that as an investor, when you're exiting, right, you first want 10 times your money, in this case 7 times your money, before anyone else gets any money. But what you do with that is you make a company uninvestable, because every new investor thinks, I'm not investing in that if they are getting 7 times before anyone gets. You're totally demotivating the founders, because the founders are not getting any money, even if they start a business for 15 million. First, these fuckers are getting their money, right? And then so from an individual asset perspective, the investment you've done, it seems sensible, but you're actually destroying the underlying business. That's a great example, I think, of spreadsheet warriors that don't understand that that's actually not how you should invest. We looked at this company, thought underlying stuff is great, but we need to fix this. So we went literally to them, say, if we can just sort of get rid with all those liquidation preferences, then
how? You bought them out, or
yeah, well, so that we just had a lot of conversations with them. Luckily, some of these investors understood the only way to get any money back on their investment, because this is also very spreadsheet warrior. Their sort of fund mandates had run out, so they couldn't reinvest themselves, even though sort of stuff was happening under the surface. And then a lot of VCs will say, yeah, sure, buddy, but if you really want to, you can. Okay, yeah, that's true, maybe, right? But we did our own analysis. We thought we see something good. We spoken with all these German investors. We said we need to liquidate that. If you're willing to take them off the table, then we can potentially invest. Done the investment. It was 396 pages of documentation, which is a lot. It's just crazy, right? So we did the work. But the company's doing great now. It's one of our fastest growing companies. We have a very significant stake in this company now. Not VC-like, right? So it's way more than you typically get for a very good valuation. Wow. And I think that's just a contrarian investment type, right? And we also managed to get actually the founder some shares back. So it's great for the founder as well, because he is way earlier in the money than he was before. And I think that's what you also should always optimize for. Like people say that, right? Like it's like a marriage you're entering into with VC, but it is like a marriage. So if he wins, you win. That's something I think you should hold dearly to your heart. So we invested in that company. It's called Troy, by the way. It's a German company. They're doing really great. So if you're ever looking for DCA in Germany, sign with them, because they're just awesome. Wow. Very agentic company. What else? Yeah, we've invested in Magic Lane, totally different company. What they're building is untraceable, fully functionally offline navigation solution. So it's like Google Maps.
Something like a Tesla. Oh, okay, a Google Maps.
It's like Google Maps. But yes, they also have a app for consumers, but it's more sort of the technology sort of behind this for enterprises. For think for instance, military purposes, right? Think you want to sort of not necessarily at the frontier, but maybe you want to move some troops for a training mission from base A. It should be untraceable. should be working fully offline, because if you need reroute in shitty Wi-Fi reception area, you need to be able.
Logistics almost, like military logistics.
Yeah, and this is a great example. For instance, a big customer of them is the German police force. And German police was just using Google Maps. So criminals were just looking and they were just tracing these
guys, get out of here, the police are coming.
They were literally that was literally happening. And then sort of you have two movements. So that's again sort of an example of, you don't need to reinvent, but if you can make it offline functional, if you can make it untraceable, and by the way, it's European, and don't we sort of want to have our own security in Europe, which is a big theme in Europe now?
Yeah.
You have a company that can sort of solve this need and can do really well. So it's, I think, a very good example of sort of European sovereign tech. That's not something radically different. It's not that their tech is radically better than Google Maps is. Try to be better than Google, right? But it serves the purpose it needs to serve way better.
Yeah.
By understanding how sort of the use case in Europe works, and Google cannot touch it, right? They just can't.
Yeah, that's really powerful. So like one of the edges that you have here, right, is like if I were to recap, right, like proprietary deal flow, right, like you're talking about, it makes sense. Everything on the internet is searchable by AI. So where's everything's noise at this point? So where do you find real signal? I've seen other VCs. How they do it is they literally go and work for their companies just to get a feel if this the startup is worth investing in. And I guess the edge for no such is the founders that work for it already have a good feel or spider sense, I guess, for the startups that they want to invest in.
Yeah, like nobody has a special tingly feeling that gives them.
Sorry, yeah, but no, but like an instinct is what I was gonna say. Yeah,
I think our edge is definitely our network. It's just because we have these now 180 successful entrepreneurs. They'll get so many, like they're approached as angels every day, right? Sort of like, hey, they're no names, in the industry. They have great networks. Everything they find that is interesting enough, they push it to us, and we can consider. It's also nice for them because then they can sort of use us a bit for DD, and then they can invest if they like it. That's our edge. Also, that's why founders like us over other VCs, because they just get to talk with one of their heroes in the industries during our sort of a courting process, right? When we're still sort of trying to flirt a little bit and try to win the deal. So I think that's a great edge. In all honesty, it's very hands-on. I like it that this other VC is literally working in the companies. But how are you even managing more than 5 investments at the same time? Then, like, it feels very.
No. They'd only do it for like a month to get a good sense of the founder. So it's not like working for them full time. Yeah. Yeah. So yeah, and I like also the other aspect where you actually champion the side of the founder, right? Like you actually defended them. You're talking about that Troy company and how you helped them like get out of that situation just because they had some bad luck from their customers. Yeah,
but so you need to do that, right? It's also the industry is very small. That's in Europe. It's also true in the US. Everybody meets each other. It's way smaller than you think. So you. Oh, sorry, I got a Slack message.
Oh, no worries.
Someone calling me. No, so it's very small. So the only thing you really have is your reputation. So all these people need to sort of, this is now a nice successful marriage. We need to sort of, after he exits really great, he needs to invest with us, or he needs to recommend me to his mates. And you need to champion them. You need to put them first. Because he needs to do the work, right? The founders need to do the work, and it's also, I think, sometimes you call it founder friendly, but we are very much optimizing for our incentives aligned. So it also means we always invest with our own money. That's not weird. A lot of VC partners are doing that, but everybody that works at No Such Ventures, including our analysts that are coming straight out of university sometimes, invest with real money because we believe they're with their own money. It's sort of, if you work for No Such Ventures, relative your salary to any of your peers at a different VC is horrible. Not because we pay shit, but because we require you to invest a lot of your salary into every investment we're doing. Because we also don't want them to play with somebody else's money. But no, you need to make a real entrepreneurial decision. And founders also love that, right? So we aggressively optimize for aligning interest, and it also means sometimes we think, okay, on an asset level, it might be better to have preference shares with a 2x lick pref. We're not going to do that because we will screw over the founder, and in the long run, that will not help the company. But if you feel that you're going at it together, and they win very bigly, then we also win very bigly. And I much rather have
bigly.
no, it's just I much rather have a lot of small pieces of big pies than sort of a big piece of a pie that goes bankrupt.
yeah, totally. And I love how you took the concept of skin in the game, even like team wise and operational or team wise, yeah. So at that time, I just want to say like we're up to time or close to time, but I want to say that this has been a really insightful education, at least for me and the viewers here. And you know,
this is just my view, right? It's nothing
no,
that I'm
but
saying is the truth or something. It's
no, but it's his perspective, right? And
yes.
and even if it's against what even Europeans in general over there would say, it's contrarian. So it gives another dimension to it. So I really appreciate it. So Thijn, for folks who are probably working in Europe right now, or VCs who operate in Europe, what's the best way to connect with you and know such ventures?
Yeah, everything works. So send me an email, send me a WhatsApp message. I think my mobile phone number is even on my LinkedIn.
Oh, okay.
Yeah, because like just find me.
Yeah.
You can also go to our website. It's nosuch.vc. There you can just join us, and then you can put your pitch deck up and ask for funding. The big requirements, you need to be in Europe indeed. So we only invest in companies that are incorporated within the European Union. That's a hard criteria, but anything else, happy to have a look at. If you're scaling fast, so you need to have commercial validation. If you're scaling fast and you need help scaling across borders of the member states in Europe, that's where you should call us.
There you go. No Such Ventures. Thijn, really great having you over. And for the folks who've been listening all throughout the podcast, thank you for joining us. We'll have a good rest of your day. And Thijn, good rest of your week too.
You too, Edward. Cheers.
Yeah.